Hi everyone, welcome to my live video. If you're watching replay, welcome to the replay. My name is Hannah. I help people reduce the tax in a healthy way. So today we are talking about what are the strategies for 100K plus earners so they can reduce tax. So why 100K plus earners? Because in the UK, when your personal earning hits 100K, then you actually get into the trap, which you are likely to be highly taxed. First of all, when you hit 100K, you start losing your personal allowance. And secondly, if we were doing the math, every £1 actually you earn over 100K, you actually have to pay 60p tax to the government. So we don't want to pay 60% in tax to the government, but when your earning actually hit 100K, that's something you might be facing. So today we are talking about there are a couple of strategies you can use that can help you to mitigate that 60% tax, and also eventually it can help you for your future. Today in this video, I'm sharing the top 3. Of course, there are other things, depends on the individual. So if you want to more about me or more questions, I put my private Facebook group link in the description. Every week I do Q&A, so if you want more of me, you can be free to join the group. Okay, so let's talk about the top 3 tips. So first of all, what you can firstly consider is using your pension contribution. So what can happen is when you can contribute to your own pension scheme, the taxman actually top up with some tax credits, so make your pension pot bigger. Because your pension, the money you pay into your pension pot is still yours, and it's serving you for your future. So it can be very beneficial that when you contribute to a pension pot and then government actually top it up. So for 100K earners, you are taxed at 40%. Some of them might be taxed at 45%. So what can happen is every £60 you put into your pension pot, the government will top up by £40. So that's a very good return. If we are doing the math, that's like 60% return. So no investment, no savings can give you that type of return. So contributing to your pension actually is a really good return and relatively safe. So some people might think they want to have an investment property portfolio for their retirement. But in comparison to the pension, first of all, it does give you a good return, and secondly, you don't expose to the tax. You get more tax burden when you do the property investments. So that can be really beneficial for you, and also not just for you. If you have your family member, so you can even start putting a pot to your kids, so they can get tax relief too. So that can be really beneficial for your whole household. So not just yourself, but also for your family. Okay, the second thing you can consider that is perhaps it's very common, it's called ISA, so individual savings account. What it does is it's just a savings account. Of course, lots of people think it's a saving account, but then when you put the money into it, you actually have your money in the tax-free environment. So lots of people think that's a saving account, that's just cash. Actually, it's more than just cash. You can have stocks and shares ISA. So what can happen is if you earn money from your stocks and shares investments, or even you can earn money, within ISA, there are also property funds. So if you earn the good return from it, that is a tax-free environment. So that can be really beneficial for your long-term return. So that's the second thing you can consider. And the third thing, it can be relatively riskier, but then in return, you get a really generous tax break. So in this country, because the government want high net worth individuals, want them to invest in startup companies. Like there are lots of startup companies, very ambitious. They have a really good solution to the problem and really innovative. So government wants more of these startups to grow. So what they do is they have this sort of a venture capital trust fund. I really enjoy tax tips. Thank you. Thank you very much. So the venture capital trust, what does it do is it's a money feed into these startup companies. So for the investor, if you're a 100K plus earner and if you invest in these startups, say you invest £10,000 in venture capital trust, you actually get £3,000 back in cash from the government. So 30% of whatever you invest. That is a really generous tax break. But the downside of that is, you're investing in startup companies. That can be quite risky. There are lots of startup companies, not all of them will succeed. Most of them might fail. So it can be really risky. And also you have to put your funds, you have to invest for at least 5 years in order to keep that sort of benefit. Okay, something pop up. Okay, so yes, there's a pros and cons. You do get a very generous tax break for that kind of investment, but then the downside is it can be risky, and also you have to put your money, you cannot move your money for 5 years. But also the other benefit is if the startup company, they actually succeed and they start paying dividends, you get tax-free dividends. And if you sell your shares, you actually it's free from capital gains tax as well. So that's a really good return. So yeah, as said, the top 3 we've shared for today. First of all is a pension contribution, and second thing, that's your ISA, which is a tax-free environment, and third thing, that is venture capital trust. All these 3 you can consider, but of course this is just information, so you are aware. But I would suggest, if you're really interested in, do seek for proper financial advice. There are financial advisors, they can help you to analyze your risk profile. And also, they are regulated, and they can also suggest what kind of funds you invest in, because there's some venture capital trust funds, like fund manager, they actually do all the due diligence, and they make sure the startup company, they have the potential to grow. And even themselves, they have people sitting on their startup, the board members of their startups, so to make sure the success rate can be higher. So there are a number of ways that people are doing in order to mitigate that venture capital trust risks. But then I would always suggest, for all these sort of investments, first of all, you need to know your objective. You need to know how much money you need for the short term and how much money you can afford to invest for your long term. And of course, everyone, we should always consider put some money aside for your long term. The first thing, always consider pension contribution, and then you can consider ISA, stocks and shares ISA, as well as a venture capital trust. But then, look for proper financial advice. Okay, so I hope you find this one useful. Of course, if you want more of me, I do run weekly Q&A with your tax bill every Wednesday. So that's within my private Facebook group. So I only share with my group. So if you're interested in, and if you want more of me, join that group. So I will go live every Wednesday. And also, just so you know, I'm running tax advisory only program that is called Falling in Love with Tax, where I will share more in-depth tax strategies with 100K plus earners. So that's one of the webinars in it where I'm going to run. So if you're interested in that program, that's webinar series, click the link in the description so we can book a discovery call, so I can really analyze what's your situation, what are your needs, and then see if the program is actually a good fit for you. Okay, so if you do have any questions, be free to let me know. Make sure you join my Facebook group so you can ask me more questions. You can bombard me as much as you can. If you want more of me, yes, do join the group. Otherwise, have a wonderful evening, and I shall see you very soon. Bye now.